Hello and welcome to the Cold Start Corner for a three-part series, Practice Valuations 101, where we will be demystifying this world of practice valuations. So today in part one, it's all about financial statements and more importantly, calculating the earnings basis measures. Now, by the way, when I say calculating, if you haven't already, be sure you make your way over to the Cold Start Corner at Akrinos.com, where you will find through all three parts of the Practice Valuation 101 series, we're making available simulators for you to utilize. And we'll actually be referencing them through the process. So again, today in part one, it's all about understanding financial statements and calculating these earnings basis measures. That then is going to set us up for part two, wherein we will take these reconstructed financial statements and these earnings basis measures and actually apply them to the modern business valuation methods. And then we're going to pull it all together in part three, where you will actually calculate the value of whatever practice you're exploring right now. We're actually going to calculate a ballpark value for you, but more importantly, provide what the next steps will be in your journey as you're going to purchase that fixture upper practice, or perhaps you're coming to us as a seller and eager to sell your practice. So let's go ahead and jump right into it. So part one of Practice Valuations 101. Again, this is all about financial statements and calculating the earnings basis measures. So look, obviously we all know that when you're buying a business, well, you got to see what the financial performance is, what the historic performances of that business in question, right? Because really what this is all about is taking past performance, coupling it with current research on kind of the current landscape of that market, and then also applying some forecasts to it to determine, if that business is going to continue producing that desired economic benefit to its owners. It sounds simple. It's not, and it's complicated even further given these next two reasons. First and foremost, the fact that private practices, just like many closely held companies, they're typically managed to minimize taxable income. And point number two is the fact that CPAs, no two CPAs exactly approach these financials the same way. And look, and trust me, because we're seeing financials from doctors across North America. So that being said, our goal here is to reconstruct these financial statements, most notably the income statement and the balance sheet, and also calculate earnings basis measures in such a way that we'll be able to really reveal the true economic potential and earning power of the business when we get into these later parts. Okay. So first, I'll invite you, again, make your way over to the Cold Start Corner at Akrinos.com. And we're going to go ahead and jump into this. And it's going to start with the income statement and income statement reconstruction. So what is the income statement? Well, the income statement is also commonly known as the profit and loss statement. And it's just that. The goal of it is to really identify what the net income is of the practice in question. So it's going to consist of revenue, expenses, and net income. So again, if you're over here at the simulators at the Cold Start Corner at Akrinos.com, you can go ahead and start populating these, right? So gross revenue, what are we talking about there? That is the top line gross revenue of the business. It's typically really easy to identify right there on the income statement. And closely there under, you're going to find your next line item, and that's going to be returns, discounts, and adjustments. Now, this is where things do get very interesting and unique in modern eye care. The reason being that commercial vision plans typically play such a big role in the revenue, and depending on how those are accounted for, the returns, discounts, and adjustments on that income statement may be pretty significant. But ultimately, you're going to have that gross revenue less those returns, discounts, and adjustments to arrive at net sales, right? So this is only just the beginning, because then from net sales, we're going to want to pull in the cost of goods sold, right? The COGS. Now, if you want to learn more about that, you can go back to one of the earlier episodes of the Cold Start Corner where we talk about kind of expenses across the practice, right? COGS, general overhead, occupancy, payroll, what have you. But here, when we're reconstructing a financial statement, it's important that we take net sales and then deduct immediately cost of goods sold to come up with this gross profit. Now, once you got this gross profit figure, things really start to get interesting. And that's because now we need to deduct operating expenses from gross profit. And this is typically where those that are doing a do-it-yourself business valuation, kind of where they'll sometimes make their first mistake. It's important here for these purposes when you're reconstructing the income statement that you include the owner's salary in operating expenses. And you'll see more why momentarily, right? So we've got gross profit minus the operating expenses. So again, I want you to think of everything here outside of your cost of goods sold. So everything outside of inventory. Again, your payroll, your general overhead, and also paying yourself. All of those figures are to be included in your operating expenses. That then is going to leave us with operating income. We're not done just yet because we then have to deduct taxes to come up with what the net income is. So once again, if you're looking at financial statements of that practice you're looking to purchase, or perhaps you're the seller and you're looking at your financials, wanting to kind of piece this stuff together. Again, you want to start with your gross revenue, less returns, discounts, and adjustments to arrive at net sales. You then subtract out cost of goods sold. Once again, cost of goods sold being your inventory to arrive at gross profit. Then when you're deducting out operating expenses, again, be sure to include every operating expense there, inclusive of owner salary, to arrive at operating income. Lastly, deducting taxes before arriving at net income. Now, perhaps I haven't said too much that you're not already familiar with as we've gone through this, other than being sure that you're including owner salary in the operating expenses. But here's where things get interesting, because it's really important, given how different practices and different CPAs will manage the books for different practices. It's really important that we make adjustments to the income statement, because it's critical we calculate these earnings basis measures before moving any further. So I'll invite you again to now toggle over to the adjustments to income statement simulator in the cold start corner at Akrinos.com. And by the way, if you're listening to this as you're driving through our podcast, definitely be sure when you get to your destination, you got some time, go to the cold start corner at Akrinos.com and check out these simulators. So in this adjustments to income statement simulator, you'll see we're going to start with that net income. So take the net income that you generated going through that income statement reconstruction simulator. We're going to start with that net income. Here is where we itemize some of these expenses that are going to need to be added back or otherwise adjusted to arrive at those earnings basis measures. So we have net income. The first of these notable adjustments is going to be that owner operator salary. So if you'll remember, we included it in the operating expenses when reconstructing the income statement, but now in the adjustments, we want to have it carved out as an itemization. So we got net income, we've got owner operator salary. Next up is going to be the replacement of owner operator salary. See, because it's very important to understand, as we are all aware, in modern eye care, there are a lot of players coming to the table to purchase practices. So, and again, we'll get to this momentarily when we start talking about seller's discretionary income and EBITDA and the differences there. And you'll see why it's important to have both owner operator salary and then a replacement of owner operator salary as a separate adjustment. Next up, regarding our adjustments here, depreciation and amortization expense, interest expense, and those taxes. So now we're going to put it all together. And by the way, if you are there playing with the simulator, then you're going to see seller's discretionary cash flow and adjusted EBITDA are calculated for you in real time. But I'd like to walk through this for a moment for our listeners out there. So calculating seller's discretionary cash flow is all about identifying what the net economic benefit is to a single owner operator, right? So most practice owners, that's it, right? You are the owner operator. So as such, the economic benefit that you will derive as the owner operator is different from what that economic benefit would be if you were looking at the practice as an investor, right? Because most notably, you have to pay for a doctor to be in the practice. So when we calculate seller's discretionary cash flow, what that calculation is it starts with the pre-tax business earnings. It's then going to add back non-operating expenses, plus any sort of non-recurring expenses. Add back also depreciation and amortization expense, that interest expense, and that owner's operator salary. And that then is going to arrive at that seller's discretionary earnings figure. And again, we'll be taking that earnings basis measure and applying it to different valuation methods in episode 2, and you'll see how those pan out. So the other key calculation here when we're talking about these earnings basis measures is that of EBITDA, or more specifically, adjusted EBITDA. And EBITDA, as many of us has come to be aware, is earnings before interest, taxes, depreciation, and amortization. And adjusted EBITDA takes it a step further. So you're going to want to start with your after-tax net profit. You're going to want to add back interest, add back taxes, add back depreciation and amortization expense. And here's where you're making the adjustment, because you're also going to want to add back that owner-operator salary and then subtract out of that figure what the replacement of that owner-operator will be. So if this is starting to make sense, and again, be sure you go to the calculators at the Cold Start Corner at Akrinos.com, and you'll see how these numbers come together, and you'll see the difference between seller's discretionary cash flow, economic benefit to an owner-operator in the business, compared to adjusted EBITDA, economic benefit to an investor who has to hire a doctor in the business. So really, really fascinating stuff. And I know for many of you, this may be the first time that some of this confusion starts to really get some clarity to it. So moving along from here. So we've touched on income statement. We've calculated your earnings basis measures, again, that are going to be used in later episodes when we're creating some of these evaluations. And lastly, we're going to want to go ahead and reconstruct the balance sheet. Now, what is the balance sheet? The balance sheet shows assets, liabilities, and ultimately equity of the business. So click on over to the balance sheet reconstruction simulator there at the Cold Start Corner at Akrinos.com. Pull out that balance sheet for whatever practice you're investigating. Again, perhaps you have the financials for that fixer-upper that you're ready to make an offer on, or perhaps you're in a position and you're ready to take on a partner or sell your practice. So pull out that balance sheet, make it on over to balance sheet reconstruction, and you'll notice some of the key elements that are going to be pointed out there. First and foremost is going to be cash, and you want to adjust that for working capital, right? Then it's going to be accounts receivable and inventory. Other current assets, collectively, those are all going to be your total current assets. And you can think of current assets as being kind of more liquid. Like you typically look at the 12-month mark on being current asset versus fixed asset. Then we take it a step further, and we're going to want to calculate what those fixed assets are. So these typically are going to roll up to furniture and fixtures, equipment and computers, which is a very large figure in modern eye care, leaseholder improvements, and other fixed assets. Sum all those together and get that total fixed asset figure. You're then going to want to pull out accumulated depreciation and put all that together. Your current assets, your total current assets, your total fixed assets, less that accumulated depreciation to come up with that total asset figure. So now we're going to move below the line, and we're going to start talking about liabilities on that balance sheet. Again, really easy to pull right there from many financials. This is an area where there's far more consistency across practices and how CPAs will account in the balance sheet. So regarding liabilities, you're looking for accounts payable, taxes payable, and any other current liabilities. This may be in the form of perhaps bonuses or payroll or employee benefits, what have you. Sum all those together to get what your total current liabilities are. Again, everything that's payable right now. And then we're going to jump over to your long-term liabilities. And long-term liabilities are going to be, shareholder loans. There's actually a slew of different other long-term liabilities. You can do some Google searches and find some of those. But do be sure to identify if there are any outstanding PPP loans or other SBA loans that the practice may have been benefiting from throughout the pandemic. So you put all those together, and you come up with that total long-term liabilities figure. That plus the current liabilities is going to give total liabilities. And then balance sheet 101, total assets minus total liabilities is going to arrive at that total equity figure. Now, from a balance sheet standpoint, again, there aren't really many adjustments to be done here. Why? Well, balance sheets are typically managed pretty much the same way across CPAs, right? As far as preparing the financials. And number two, the income statement is all about kind of that operating income potential, the degree to which that business can generate cash, right? So that's why we wanted to do all those adjustments in calculating those earnings basis measures, seller's discretionary cash flow, and that adjusted EBITDA figure from the income statement. Whereas you'll notice with the balance sheet reconstruction here, everything is pretty straightforward. So that about wraps it up for this part one of Practice Valuations 101. If you haven't already, go ahead. You can view these videos again. And definitely, if you have not already, make it over to the Cold Start Corner at Akrinos.com to play with those simulators. And stay tuned, because in part two, we're going to now take our income statement that we have reconstructed, those earnings basis measures that we've calculated, and our balance sheet that we have reconstructed, and we are actually going to apply them to modern practice valuation methodology. So as always, please do send your questions over to us. Visit Akrinos.com. You can connect with us. We'd love to hear from you. And wishing you all the best on this journey as you are looking to purchase, take on a partner, or otherwise sell your modern eye care practice.